like this, man. He's like a butterfly flapping his wings deep down into the forest, man. It's gonna cause a tree fall like 5,000 miles away, man. There ain't nobody seeing nobody. Man, see, like, you don't even know, man. It's like you're born into this world, man. And you got like that, man. That's the wind, man. Or like a dang old candle, man. It don't matter, man. It's like this all the time.
All right, Peruvian Bull. Welcome to the Jay Burden Show. How you doing, man?
I'm doing really well. How are you?
I'm doing quite well. I'm glad to have you on. Recently had a mutual friend of ours, Stormy Waters, on, and I really like talking to you finance guys. Right, I have a passing understanding, but nothing deep, and so I always welcome the opportunity to learn more from you guys.
Of course. I still don't know. I refrain from calling myself a financial expert. I'm just a researcher. But I also got a degree in finance, and as we were talking before the show, it was mostly useless. So
yeah, it was actually funny. I mean, basically, functionally, I realized after like a year in industry, I could have literally gotten a degree doing almost anything and gotten the same job. And that was a little bit depressing. But yeah, I've been out of it for a while now and have no desire to return. But man, obviously, I know who you are. I follow your work, but my audience might not. So who are you and what do you do on the internet?
Sure. So I write under the pseudonym Peruvian Bull. I would say I'm a macro researcher and writer. I've been writing since about 2021. I first wrote my main series called The Dollar Endgame, which was hypothesizing how the U.S. could lose world reserve currency status and the implications for the dollar and inflation domestically, as well as the global economy. I've also been active now on Substack. I've been writing and producing podcast content there, and I also have a YouTube. So where I'm trying to ramp up production for the normies, trying to educate them on what's going on in our financial system.
That's actually an interesting point, and this is not in the notes that I sent you, but I am naturally cynical, especially of anything I read on the internet. So to me, I have conflicting feelings about de-dollarization, right? Mm-hmm. Because on one hand, and look, if you've been on the internet for any period of time, you'll know that there's always someone running around saying, the floor is about to collapse. The dollar is going to go to nothing. We're all going to die. I mean, that's been happening my entire life. But at the same time, it does seem like there are large blocks of the world that are making moves, at least, kind of initial moves to move away from the US dollar. So what's your opinion on that? I mean, how much of a threat do you see de-dollarization?
Sure. Yeah, that's a great question. And I think that's a good place to start, right? Because this is the issue that everyone who follows, follows the so-called rabbit down the rabbit hole starts to run into, right? Because the first stage is you run into the gold bugs and you run into the neo-Austrians who are telling you, buy gold, inflation's coming, the Fed's going to print us all to oblivion and everyone's going to die, right? And so if you're following that rabbit hole, you run into Peter Schiff, you run into Ron Paul, you run into Mike Maloney, and you start saying, man, the arguments these guys are making sound really cogent, sound really powerful, sound intelligent. So I'm going to start buying gold and shorting Dixie and getting ready for the end of the dollar. And then as you progress further down this rabbit hole, you'll start finding out that this argument has a lot of nuance to it. And it's not as simple or clean cut as a lot of these people would have you believe. So that's where you start to run into Dollar Milkshake by Brent Johnson. You start to run into, geopolitical war games and, Luke Groman's Mr. X thesis, as well as, other people have written in the macro space on this topic. And it's much more of a, 3D chess match than most people want to admit. It's not a simple cut and dry topic to approach.
So I'm going to ask you to sort of play devil's advocate here. Could you give your kind of honest take on, let's just say, that gold bug argument? Like, what do they say and why are they wrong?
Sure. So yeah, I was just about to launch into what this whole, what are the caveats? What are the truths and incorrect assumptions of gold bugs and, others who believe that the end of the dollar is near. And again, the book I wrote is called Dollar Endgame, right? So I am saying the end of the dollar is coming. I just had to caveat it with 50,000 different, statements saying, look, it's going to, I think it's inevitable. And even the people who are bullish on the dollar know that this system is terminal. The structural problems, the structural imbalances cannot exist forever. And so it must at some point reach its terminal end. But the issue is, how does it get there? And how long does it take? Because clearly the gold bugs were wrong. The gold bugs came out, right? I would say they were most powerful in the 1990s. And they were, proclaiming that the U.S., and, they also had this, there's an echoes of this in the 1970s as well when we went off the gold standard. But they're proclaiming that, look, the dollar, once we disconnected from the Bretton Woods monetary system in August of 1971, the dollar was no longer linked to gold. And Kissinger and others in the State Department had to find a new way to back the dollar. And what they found was the, emergent petrodollar system. By signing an agreement with Saudi Arabia in 74, they were able to kind of quasi back the US dollar with oil. And then by forcing oil exporting nations to use dollars in foreign contracts, they're able to enforce dollar hegemony in global trade, which creates artificial demand for dollars. And what they said is look, the US doesn't actually produce that oil. All of that is incorrect. That means the dollar is actually backed by nothing. It's backed by debt. And that means that this entire system is going to come down tomorrow, and gold is going to rip to $10,000 an ounce within short order. The issue with that argument is that even though it's maybe correct in a very simplistic view, it negates the fact of, or the effect that network effects and, what you could call like a latency or like a Lindy effect has on markets. So once the dollar begins to be used as a global reserve currency, especially, post 74, when it's used as a petrodollar and like a trade and settlement currency, there starts to emerge a system that's called the Eurodollar system, or the offshore dollar banking system. And this is where, foreign banks, starting with the Midland Bank in 1955, but in the UK, but slowly more and more foreign banks, European banks, Asian banks, and then later on Middle Eastern banks all start lending in USDs and borrowing in USDs, and not just for oil trade. We're talking, copper, uranium, food, settlement imbalances, everything. Like all trade starts to get balanced and settled in dollars. And this creates an effect where foreign banks start to desire to borrow and trade in dollars, because why would you borrow and trade in your own currency when you have to hedge that against the dollar? And foreign companies who obviously trade in dollars want to be borrowing in dollars, and so that way their cash flows that they earn from from sales to US importers can be settled against their dollar debts. And so this system is kind of like an emergent native market force that starts to grow and evolve throughout the, I would say, 1960s to the 90s, 2000s, and even today. And it slowly grows into a behemoth, truly. Like from, I'm not sure if you're aware of Jeff Snyder, but Jeff Snyder's research, this market was north of like 5 billion in the late 60s. It grew into the hundreds of billions throughout the 70s. It hit 1 trillion in the 1980s. In 2006, they did their most comprehensive analysis of the Eurodollar market and estimated it to be somewhere north of $40 trillion. And today, it's likely north of $100 trillion. And so, like Stormy Waters says, that's 10 times the size of the domestic global dollar market. So this system that's been created, right? These dollars that are flowing all around the world that are being used to settle trade imbalances are, mainly a function of this private debt creation. And remember, private debt creation from a commercial bank also creates demand. So if a commercial bank loans dollars, to a supplier in Iran who's trying to get their hands on uranium, now that supplier needs dollars. So by loaning more dollars, they're creating demand for future dollars. And so the system kind of self-perpetuates in a way where more debt begets more dollar demand, which begets more debt, which begets more dollar demand, and on and on and on. And the staying power and incumbent power of the system is much more powerful than people had previously believed, which is why the gold bugs are they're right and they're wrong, right? The system is terminal. The debt cannot grow forever because, as you know, any sort of compounding interest rate will eventually result in exponential growth. But the issue is it's much more, it'll last much longer and be harder to replace than most people think, especially the gold bugs. And so that's where you need to kind of caveat their theory.
Yeah, it's interesting. I grew up in a fairly conservative area, right? And so the gold bug is a character I know well. And, obviously, look, like they are fundamentally right about their argument that, the same laws of, this is inexact terminology, but the same laws of monetary physics that apply to you and I apply to governments.
Mm.
So like given a long enough time span, they're not wrong, but it's like, hey, look, you've been stockpiling gold since 1987. I don't know, man. Maybe it's not coming tomorrow,
No, it's not. That's the thing.
So, and I'll get back to the questions I had you prepare for, but when we're talking about the system sort of starting to fail, right? There are starting to be cracks in this system. Where do you identify those cracks? Where's a place that you can point and say, hey, look, things are starting to break down?
Sure. So this is actually a really good place to start, right? Because again, they say, okay, well, is de-dollarization happening? Yes or no? And I would say, both. Yes and no. It's happening in some ways. It's also not happening in other ways. It's not happening in the ways that they think. So the main metric that most, gold bugs would try to use is $% of global trade, right? Or $% of settlement balances. And that number hasn't fallen really for the last 20, 30 years. It's around, 60 to 70%. The dollar is 72% of global forex reserves. It's 60% of global trade imbalances. It's 80% of global interregional trade. Those figures have remained pretty steady, actually. And in some areas, they've actually increased because the share of global currency trade that the euro has taken has been falling because of weaknesses within the euro area, obviously both because of the Greek crisis, but also now because of their current migrant crisis, inflation crisis, energy crisis, and lack of faith overall in the European political system. So today, as we speak, the dollar share as a percent of global trade is not falling. However, dollars, dollar holdings or let's say holdings of treasuries by foreign central banks has been falling, and percent of treasuries held by foreign private investors has also been falling. So if you look at a chart on FRED, which is the Federal Reserve website, if you look at a chart of foreign holdings, direct holdings of U.S. Treasury securities, you'll see a massive increase in 2008 as we borrowed a huge amount of debt to fund the, Great Recession programs, TARP, TAMF, all the Treasury programs to save the system. You'll also see a slow and steady increase up until the mid 2010s. And then you'll see a flat line, and you'll see a further jump in 2020, but it's much, much smaller than previous years. And, to lay some numbers on that, around 72% of all debt sold between 2008 and 2010 was sold to foreign central banks. So large foreign investors. Fast forward to 2020 to 2023 timeframe, only 14% of all debt raised was sold to foreign central banks. So foreign central banks are no longer truly buying treasuries en masse. The Chinese were one of the largest ones to bail us out of 2008, and they're no longer coming back to the table to purchase U.S. Treasury bonds. And that's true across almost every single central bank globally. I don't think there's a single one, except for maybe Japan, that has been steadily increasing their holdings since 2015. So that's one of the first warning signs that we're seeing that, aversion to the US dollar is building. And again, this is actually, when you think about it, logically, it makes sense, right? What is money? Right? What are bonds? What is debt? Well, money is debt, right? And cash money in its most physical form is the closest and most real, low time preference thing that we have that we can spend immediately, most liquid. But U.S. Treasury bonds in the financial system, maybe you and I don't think of them as money, but they are money in terms of the U.S. financial or the global financial system as well, in the U.S. and the global financial system. And so the farther you go out in maturity, the less money-like those instruments become. So, a 1 month bill, a 3 month bill, a 6 month bill, those are extremely cash-like. If you're an institution, you can trade those for basically par value for their cash. And so you can say, I have 100 million of US Treasury bills expiring in 1 month. I'm going to post them as collateral to, a repo facility. Boom, I get $100 million or maybe $99 million with a slight haircut on the bonds. But the further out you move on the duration curve, you're taking out more and more duration risk. And so those longer dated bonds, which are much more sensitive to interest rates, are almost like a more volatile form of money. And so obviously as central banks start to de-dollarize, the first thing they would want to de-dollarize are the long bonds. The first thing they would want to lay off are these bonds. And so we've been seeing a general, withdrawal of liquidity on the long end of the curve, especially from purchasing long bonds. And this isn't just foreign central banks or foreign private investors. This is also from domestic banks. So domestic banks also don't really want to buy long bonds, which is shown by the Treasury itself. They've changed their issuance schedule both in July of last year and in November of last year to favor more 2-year and 5-year notes and more Treasury bills rather than long bonds. In fact, Q1 of this year, I think 71% of all funding was done with Treasury bills, not bonds, which is emblematic of a banana republic.
Yeah, it's actually an interesting point because when I was going back through your Twitter, that banana republic phrase came up. So if you want to, and look, we could talk about this, all afternoon, right? But can you explain why that transition is emblematic of, a banana republic, of like one of these third-rate countries where the rules don't really exist, right? Why is that atypical for a quote unquote real country?
A developed country, right? An advanced country, a country that's supposed to be fiscally responsible. Well, so if you ever work for an emerging markets desk or a developing markets desk in, at Goldman or JP Morgan, what you'll learn very quickly, especially if you're working with government bonds, is all of these third world countries cannot fund on the long end. So the rule is, it's almost like an 80-20 rule where 80% of their funding has to be done on the extreme short end and only 20% of their funding can be done farther out. So, you look at Argentina, you look at Peru, you look at Chile, you look at Thailand or Vietnam. Most investors will only lend to them extremely short term because the issue is their fiscal situation is so volatile that it's extremely risky to predict their cash flows more than a few years out, because there's example after example of developing market economies failing to pay their bondholders and just deciding to negate their obligations and pay instead, either social security programs, welfare programs, military buildup, what have you, whatever it is. They're more willing to break the rules in that way. And developed countries like Germany, the UK, and the US are supposed to be these beacons of, paragons of prosperity and responsibility. And so we're not supposed to be running a fiscal situation like that, a fiscal strategy like that. Instead, we're supposed to do the opposite. So the rule is 20% short end and 80% long end. If you look at all the developed European economies as well as the US and Canada, and that evolution from the long end to the short end is part of the process of almost like the dying of faith of in the federal government and in the fiscal strength of a country. So as we move further and further towards the short end, it's showing that investors in general, foreign central banks, private investors, domestic banks, domestic retail investors, they don't want to lend to the government anymore at long durations. So they're all only trusting government for short-term borrowing. And so that's dangerous, I think.
So look, again, I'll play devil's advocate. Why does that matter for someone who, isn't really involved in financial markets, right? How does that affect sort of the average Joe?
Well, Okay, I'd say a couple things. First of all, like we said, this is emblematic of a slow move towards de-dollarization. And de-dollarization is one of those exponential processes where, again, it's going to be very hard to find a good replacement for the dollar as the world reserve currency. But once there is a replacement, and once the dollar system is melting down sufficiently fast enough, the transition can be extremely rapid, which we've seen before, by the way. We've seen in historical examples of the Dutch guilder, or the florin, or the British pound. And so the question becomes, right, how quickly, how does this accelerate, and what happens if it does? What happens if some foreign central banks no longer will buy the 20-year, and then no longer will buy the 10-year, and then will only buy bills? Well, what happens is the government becomes essentially a giant credit card. So the Treasury will become extremely sensitive to interest rate fluctuations. So, like, let's say we move to an economy where 90% of the funding is done with one month T-bills. That means every single month they have to be raising all the money for that month, all the money for the deficit, and if the Fed raises rates, the entire debt maturity curve will move up. Like the entire debt interest rate curve will move up. So it's like in previous cycles, right? The Treasury has almost like a maturity profile, right? You can see like, okay, these tenors of debt are expiring at these times. And if they're mostly long bonds, then you'll have you can imagine it on a graph, like a very spread out, dispersed, almost like, normal distribution style maturity profile. And so only a small amount of bonds will be refinanced every year. And since the maturities are so long, they don't have to worry. If we have to go through a rate hiking cycle and then a cutting cycle, we won't be refinancing all the debt at 5%. We won't be refinancing, say, 10% of the debt at 5%. The issue is once you move to this banana republic style government, if there's a financial crisis or if there's an inflationary crisis where the central bank has to raise rates, when it does so, it'll raise rates on the entire maturity profile of the Treasury. So all the Treasury bonds will be refinanced at 5%. And now the entire debt problem becomes really an issue. It becomes really exponential. And so if you run a government like that, very quickly, if you have any sort of problem or any sort of crisis, you're going to start to have severe funding problems.
So one of the things that I've heard you mention in other appearances is the degree to which our economy is financialized. Basically, how much of GDP, which I realize is a gross measurement, but we'll work with it, is generated by financial services. So can you speak to that? Like how much of our GDP is produced by the finance sector? What is normal, and what is the difference? What can that tell us about the kind of current state of play?
Sure. I've actually written a lot of good pieces on this. It's kind of like almost like the philosophy, right, of how markets should work, how the economy should work. And I believe all of this is an outgrowth of the Fed and the financialization of the economy that's taken place under the guidance of Bernanke and Greenspan and others who've been kind of putting this proverbial put on markets, this put option, this safety net where the market can never fall below a certain percent. So bad players or, over leveraged players can never be fully wiped out. Currently, as we speak today, around 13% of GDP is attributed to the financial sector, and the long-term average for developed countries is 6%. So our financial sector is more than double the size that it should be. And I think the reasons for this is multifold, but I think a large part of the blame can be placed at the foot of the Fed. The Fed has been, running this Keynesian monetary experiment for the last 60, 70 years or so. And ever since the 1970s, they gained this dual mandate to manage inflation and manage unemployment. And the issue arises when you have a mandate to basically bail out the economy and bail out market participants whenever there's a crisis. Those participants never get wiped out. The leverage never truly dies. Instead, by lowering rates, you're actually just increasing the overall debt in the system and allowing those players to refinance at low rates and then play the game again. And so what we saw in 2008, 2010, even in 2020 was an exact repeat of this scenario, right? We saw dozens of hedge funds underwater. We saw in 2008, especially, dozens of banks on the brink of failing, and the Fed and the Treasury step in, announce massive programs, buy all these toxic assets, remove all the liquidity requirements from the banks, and allow them to start lending again. And then what happens later? They run into the same issue in 2020, and then again in 2021, and again in 2022 and 2023. And it just never stops. The repo crisis in 2019 was another example of this, right? The banks were, overexposed to the shadow banking sector, and then repo rates blew out, and the banks had to ask the Fed for a bailout. And the Fed is, by maximizing the survival of the financial system over all else, the Fed has essentially allowed this monster to grow into a behemoth, to grow into a gargantuan thing of incredible size. And so the issue that there's a lot of externalities that this produces, right? One of them, I think, which is really negative, is we're taking our smartest people, right? The best software engineers, the best physicists, some of the best scientists, and we're putting them in hedge funds like Citadel, and we're training them on how to run the, order flow algorithm faster. How do we use, the fiber optic is kind of slow. Let's use microwave towers to transmit signals from the CME to New York so we can arbitrage, microseconds of the order flow between each other. Oh, let's actually move our servers in the New York Stock Exchange. Let's pay money to move our server closer to the main market making and trade routing server. So our market, our order book will be physically closer by 5 feet. And when you're talking about, something moving at the speed of light, 5-10 feet might be a few, billions or hundreds of billions of a second, that can make the difference. And so they start to, use all their capital to employ our smartest people to essentially do stuff that's not economically productive in the real world. It's just productive in their eyes to extract wealth from the financial system.
Sorry, I was muted. Incredibly professional podcasting. This is actually something that I noticed as well, right? I went to a finance program because that's what you do if you hit certain bars, like that's what you're supposed to do. And I had this feeling like looking around my class, and I only worked in industry for a little less than a year, right? It didn't suit me. Was exactly that. It was like, why are all of these people here, right? Like really. And to be honest, the answer is, if you're a young, ambitious person, right? You're smart, you're a striver, you want to be highly compensated. That's pretty much the game, right? That's where you go to make a lot of money. And, I had this conversation with a good friend of mine, and he was making the point, he's a doctor. He went to Harvard, very, very well-educated, intelligent guy. And he was like, yeah, knowing what I do now, I'd never go to medical school. It was such a waste of time. Right. But he's exactly who you want as a doctor, right? He's incredibly intelligent, very driven. And if you sort of turn the whole economy into a solved problem, right? There's one way, or there's one of a very few ways to be highly compensated. Well, one, you're going to get a lot of competition for that. But two, it's like, that's where all of your IQ is going to go. Right. And, Spandrel has this idea of, the IQ shredder, right? Where he talks about this problem where if you take your best and brightest, jam them into, giant, office centers, data centers, whatever you want to say, in, urban areas for 10 to 15 years, you shouldn't be surprised when none of them have kids and families, right? You're just taking that genetic stock and just wasting it. And look, like, I'm still an ambitious guy. I like making money. It's not my point. But I do think that there is a problem where if there is one solution, right, to that problem of social advancement and only one solution, it does create problems. It's not like, you can get an equal amount of social prestige by becoming, a military officer, right, commanding a naval vessel, like you could in the British Empire. There's a limited field of play, and that does create problems. But sorry, back to you, man.
No, I think, dude, that's a really good point, right? So it's not only how do we how do we change the, pro incentives for going into finance? How do we also change the disincentives for other roles as well? And that's a difficult question because, again, the system is so stacked nowadays where you can, if you go into either tech or finance, you can make inordinate sums of money, and they artificially restrict, right, the stock of applicants they hire so that they can overwork them and maintain this air of, exclusivity and, highbrowedness. But in reality, it's just a giant circle jerk. The point of finance and the point of capital markets is not to figure out new ways to front run an investor or, arbitrage two prices, even though arbitrage is fine, but the point of markets is to deploy capital to entrepreneurs to do things in the real world. So our best and brightest shouldn't be going to Citadel and Virtu and Susquehanna and working to make them better market making algos, or working to front run crypto retail traders. Those people should be working on SpaceX and Tesla and whatever other issue, cancer research, whatever other major issues we need to solve. And it's truly a travesty, because imagine all the lost potential, all the lost inventions and ideas and innovations and businesses that could be, but aren't because of this problem.
No, definitely. And again, the reason I keep going back to talking about school is because, where else you get to sit in a room with 100 other of your peers, right?
Mm-hmm.
All at one time, kind of the same stage as life. And it was honestly kind of fascinating to talk to people who, all had kind of, and I mean this in the non, homosexual connotation of that word, right? But a diverse set of, skills, backgrounds and everything. And they are all competing for the same small number of jobs in, DC, New York, and Chicago. And it's like, all right, there seems to be a misallocation here, right? Obviously, look, like we need financiers, right? That is a useful, it's a useful thing to be able to provide capital to people who need it. But also, right, that is not the entire point of a civilization, right? Is to make marginally more effective, market making. It's a little bit, I don't know, it's a little bit depressing. But, I noticed this as well, and this is another thing that I picked up on kind of over the pandemic, was the way that the rise of, platforms like kind of like Robinhood, the rise of the couch investor, right? A guy who gets just kind of, a wild hair up his ass and decides to throw money around, majorly, distorted the market. Because look, I don't follow markets super closely, but one of the things that I've noticed is that there's a massive disproportionate level to which products the average American consumer do very well on the stock market, kind of independent of how well the actual company is doing, right? So for instance, right, Tesla was doing incredibly well all through COVID, largely because lots of people knew what Tesla was. They logged into Robinhood and they're like, I'll buy Tesla. And, obviously, look, like if the market, and I mean that in the most general way possible, becomes too inaccessible, you get problems. That's not my point. But there was something interesting that it's like you had this massive glut of ultra low information investors. And it was kind of funny to watch that distort the market in real time. Do you know what I'm talking about, man?
Of course. I mean, the way I gained popularity was first on the GME subreddits. That's where I was posting. That's where my first pieces were. So no, I know exactly what the retail phenomenon is. And this is part of the broader problem, right? So like, let's link this back to the initial problem of, right, the over financialization of the economy and the Fed. The Fed views, right, so they have that dual mandate like we discussed earlier. They have a third mandate, which is not spoken about, but it's their secret mandate, and it is protect the financial system at all costs. And that's been their mandate since their inception, right, which I think is inarguable, right? Anyone who studies the Fed's history has seen that at every single juncture, whenever they have critical decisions to make, they will elect to choose the financial system at any cost. So whether that means breaking their, breaking laws and creating, maiden lane 1 and maiden lane 2 as holding companies for toxic assets, whether that means changing their own charter to hold MBSs, which they weren't legally allowed to do pre-2008, whether that means buying corporate bond ETFs in 2020, which is something else they started to do, which they weren't allowed to do, and they changed to do that again. These kinds of things are, evident of the fact that they will literally do whatever it takes to save the incumbent system, because they view it as the economy. They view markets as the economy. They don't view the real economy in the full context that we view it. They view, how well is the as a SPY doing? How well is QQQ doing? Okay, then that's how well the economy is doing. And all of this is rooted from a fallacious economics concept called the wealth effect, which stems from Keynesian philosophy, which says if we stimulate asset prices to grow, then people who hold assets will become more wealthy. They'll feel more wealthy. And because of these feelings of wealth, they will go out and be more profligate in their spending. They'll go out and they'll buy new cars, new houses, new jet skis, new Beanie Babies. And that spending will stimulate the economy. So their logic is, hey, let's go out, stimulate asset prices to the moon, and we're going to be, and that will, be like a trickle down effect that affects the real economy. And in reality, that's one of the stupidest arguments you can make, because if you understand anything about consumer behavior, after a certain point, there's very, very severe diminishing returns on consumption, even as wealth grows, up until you get to like maybe billionaire level. And number two, it exacerbates wealth inequality harder than almost anything else. I mean, the top 10% of income earners in the US own 84% of listed equities. And so if you stimulate asset prices up by a few $1 trillion, 84% of that money is going to the top 10%. And that further creates a divide between Main Street and Wall Street, and allows them to, allows justification for them to continue the process. I mean, remember, the people who run the Fed are mostly former bankers or academics themselves. And so, a lot of them have large stock portfolios. A lot of them they were historically trading during, the Fed's easing cycles. So they would almost like trading on inside information, and none of them were prosecuted on it. They essentially have a vested interest in stimulating asset prices upwards. And if you look at a chart, there's a really good chart I put out that it went viral back in May of 2024. I don't have it here with me, but if you want, you can put it up and I can send it to you. But it's a chart of the S&P 500 divided by the Fed's balance sheet. And if you look at the chart, you'll see growth in the late 90s and 2000s, and then a crash after the tech bubble, a little crash, and then growth again up until 2008. And then it crashes very hard, and then it flatlines, and it basically never recovers. And so what that shows us is after 2008, systemic change happened in the markets, where markets no longer were dependent on fundamental data or economic strength. What truly mattered was the Fed's balance sheet, was liquidity. So if liquidity goes up, markets rally. If liquidity falls, markets contract. And every single time that they've tried to taper, we've seen, almost like a mini financial crisis emerge, and then they stop the taper and then they start easing again. So they reverse the process, and then markets go up. And then, of course, everyone on CNBC says, look how well the economy is doing. SPY is up 15% this year, guys. Yeah. And the homeless population is increasing, and the unemployment rate is growing. And I mean, we can point to 50,000 different metrics. The real economy and the financial economy have become completely disconnected.
So there are two things that I want to address, right? The first of which is, you will hear certain vaguely Austrian economists say something like, inequality doesn't matter. Like that's just it doesn't affect anything. What really matters is, average, standard of living, right? Pick your poison. Why do you think that inequality is something that's actually worth talking about?
No, I think it. Okay. So first of all, I get where they're coming from, and they are right to a certain extent, right? Pareto distributions are found throughout nature, and they're also found in the wealth holdings of an economy, right? A few percent of the population will hold a lot of the wealth. And that's unavoidable. That distribution seen in the height of trees in the Amazon rainforest, and the size of black holes, in the number of plays of artists on Spotify, or the number of subscribers that people have on YouTube. It's a function of human systems, or just physical systems, right? Which the human system is one of those. So a certain amount of inequality is unavoidable, but an excessive amount of inequality becomes harmful to the social order and the social fabric of a country. As you can imagine, as the system progresses, right, as the Fed continues to stimulate asset prices by creating more and more liquidity, the byproduct of that, especially if the federal government is running deficits, is inflation. So the middle class and the poor people will have price increases and real wage decreases from the inflation created by the Fed, and they will not benefit proportionately from the asset price increases from the bull markets. And so what will happen is the middle class will slowly sink back into the poor classes, and the wealthy become more and more and more wealthy, until the point where there's almost like the French Revolution, where there's a breaking point where people just say, fuck this system. Like, there's no way you can become successful, right? Especially for young men. If you're a young man now, I think it's harder than ever to get ahead, right? You can't afford a home. Even if you get a degree, the job you can get is, won't pay that much. You'll be taxed to the wazoo. Then there'll be inflation on top of that. Girls won't want to talk to you unless you make a certain amount or make more than them. And so your options are very limited. And as this system could, and as you see the boomer in your company continually get more and more successful, and his portfolio grows by more than your salary every single year, so he makes more money just by sitting on his ass, just because of when he was born and when he invested compared to you, resentment starts to build, and anger and distrust of the system start to build. And that's how you get revolutions. And so if you want to have a stable society, you need to ensure that inequality, especially unfair inequality, right? Because again, there's a certain amount of fair inequality. There's some people are born more intelligent than others. Some people are born more hardworking, or choose to be more hardworking than others. Those are inequalities you cannot avoid. But inequalities that are manufactured, like the Fed creating liquidity to pump up asset prices, are things that can be avoided and should be avoided if you want to maintain a stable society.
So one of the other things you mentioned that I want to get back to is the divergence between the market and the quote unquote real economy. And so first of all, I'm going to ask you a more philosophical question, right? Which is it possible to align the interests of the real economy and the market? Because at least for my entire life, that I'm going to go ahead and bet yours as well, that has not been the case. So is it possible for those two, I guess, spheres to co-align?
Yes, absolutely. I mean, think about how the American financial system functioned in the 1800s and early 1900s, right? Booms and bust cycles in the real economy were very well reflected in the stock market. And, any crash in the stock market also would affect the real economy. And without a central bank, a strong central bank to bail out the markets had to be dependent on the real economy, right? Like this leads to a greater philosophical point that I've made multiple times. The financial economy and the financial markets broadly are derivative of the real economy, right? What is an option? An option is a derivative of shares. And what are shares? Shares are derivative of an ownership in the company. And what is the company? If it's General Electric, it's a bunch of buildings, it's a bunch of people working, it's a bunch of products, it's a bunch of intellectual property, it's a bunch of cars, it's a bunch of washing machines, right? There are real world things you can tie these derivatives to, and these derivatives should be working in lockstep with the real economy asset. And once you sever that link, and once you disconnect the two, you create two different worlds where people operate. You create the financial world where bankers and financiers and VCs and private equity funds can make inordinate amounts of money just by moving wealth around. And then you make the real economy where people might create businesses or companies, but not be rewarded proportionately for the wealth that they create. And so that destruction, that link can only be reattached if you get rid of central bank intervention and broadly like government intervention in the markets. So you have to reintroduce almost like a laissez-faire free market style financial system to relink those two.
It's an interesting point because, one of the things I always think about, right, and you can never really get away from your roots, right? But one of kind of the core things you learn in your like Econ 101 class, right, is that effectively people, they respond to their incentives. Obviously most people, act in their own rational self-interest. And so when people will kind of opine about an era, when we had good, noble leaders, right, who just did the right thing. I mean, sure, there's some of that. But I think another part is that, you want to create incentives that align the people with their leaders, right? This is what Hoppe writes about in, Democracy, the God That Failed, right? That if you, the king, own your country, well, you kind of want your country to be around in another 100 years, right? I'm massively oversimplifying what he says, but to me, I think you see that as well in the, in the markets, right? That effectively we have massively we've created a gulf between the interests of, the people who live in a country and the people who, make moves in the economy. I think the easiest way to look at this, right, is with homes, right? So one, you need someplace to live, right? That's just a pretty low on Maslow's hierarchy of needs, but homes have effectively transmogrified into an investment asset, right? And particularly as we have this like massive, and it really is a massive aging boomer generation who is basically using their home equity as a way to, keep themselves, running, right? To keep that economy moving or to keep their, their life running is, that's creating a massive problem that, like, you're right, we're living through now, right? I mean, I live in a pretty small place and home prices have effectively doubled in the last 10 years. I mean, it's still cheap compared to, Manhattan, but I mean, like you said earlier about, compound interest, eventually that becomes exponential, right?
Yeah, exactly. And again, so what are the effects of people in your town or city, right? Can families form if the housing price doubles? What about if it triples or quadruples?
Exactly. And so, when we talk about like, the system falling apart, I think a lot of people get this kind of like Mad Max fantasy, right? Like, oh, the bombs are going to drop and we'll all be, wearing leathers and eating people, which I mean, I could be wrong. I don't see that happening. Right. But fundamentally, right. And this goes back to the things that the gold bugs are right about is that fundamentally, right, governments, no matter how big, are still subject to kind of the fundamental laws of reality. Right. And so look, like, we've been able to cheat a lot, but that only works for so long. And going back to your points about de-dollarization, one of the things that I see in that, and look, I'm not an expert. I have literally no idea what I'm talking about. But from my perspective, one of the things I notice is like, well, even the fact that we're having this discussion is relevant, right? Because I mean, you saw what happened to Gaddafi, right? Even 10, 20 years ago, this was not something that was even on the table. And look, BRICS is not, it seems to be not entirely what it's cracked up to be. It hasn't really, created a huge dent. But the fact that you have countries, I mean, like India, which is not, an international pariah saying, hey, maybe this is a good idea. I mean, to me, it signals that the sea is changing, so to speak.
It is. No, it is. And that's the thing is like, I actually wrote a research piece for a gold fund in March of this year, literally on de-dollarization. And that's the argument I was making. I was like, look, these moves, the problem is BRICS as an entity is going to have extreme difficulty in creating an alternative for the US dollar, right? Because BRICS is a loose consortium of nations that don't have a similar, they don't have a similar demography. They don't have a similar culture. They don't have a similar religious or political philosophy. They're not even, geolocated all next to each other. So for them to create a common currency is near impossible because they just wouldn't be able to agree on all the requirements and funding and settlement, factors of a currency that large. And they wouldn't also agree how to back it and who prints it and who controls it and who decides when to print, right? It's the same problem that the European Central Bank has faced.
So we are coming up on time, but I want to get you to answer one more question, which is, what sort of trends are you eyeing, right? What sort of developments do you think we'll see in the kind of near to mid future?
So I mean, my base case is a continuation of this, disconnection between the markets and the real economy. Again, I've been pounding this point home on every single YouTube video and podcast I've been on, but we truly are in, a time of of change, and that change entails markets not functioning how most people think. And so right now, as we're coming up on an easing cycle, as the Fed is beginning to cut rates and QE is around the corner, we should be expecting risk assets and Bitcoin, for example, cryptocurrency, to be ready to rip upwards again. And I think the speed of the move and the size of the move is going to surprise people. But I think that this is also going to unfortunately be attended along with inflation. So it's going to include inflation along with this market liquidity rip. If you read Mises or Hayek, they'll talk about the crack up boom, how governments can create basically explosions of credit and money in conjunction with each other. So instead of, at the end of a debt cycle, instead of allowing the debt to contract and allowing a deflationary cycle to take place, they can manipulate the monetary system to create a crack up boom and rip all asset prices and eventually inflation upwards. And I think we're in the midst of that. I think since 2020, that was the first, major canary in the coal mine that we're in the early stages of this exponential boom that's going to take markets upwards, but then also eventually take inflation upwards with it. And it's one of the early stages of the death of, the monetary system. Because again, these processes are exponential. If you increase inflation and you increase debt growth by 5% a year every single year, eventually becomes untenable. And we're already seeing that, by the way, with the Treasury. This just last week. So October 2nd was the first day of the fiscal year for the government, and the Treasury debt increased by $204 billion in a single day and $347 billion over the weekend. And, for reference, that is all of the debt accumulated in the US, up until World War I in a single day. And that process of, 200 billion being added to the debt and 300 billion here and 400 billion there. It's really it already is, emblematic of this exponential spiral we're in. This, we've crossed this monetary event horizon, and the further we go into it, the worse these numbers are going to get. And the issue becomes, right, like if the Treasury itself is seeing an exponential curve in their debt issuance, if their debt growth is going to go parabolic, who's going to fund that? Again, foreign central banks, which historically, like I said, were funding it, are now pulling back funding. Private domestic banks no longer want to fund on the long end, so then they have to fund on the short end for all of this. And private retail investors are all tapped out. The personal savings rate is basically at an all-time low since COVID. So the only way to fund this is QE. And that means inflation. So as we go down this path, 1 year we have 1 trillion in interest expense. The next year we have 2 trillion. The next year maybe we have 3.5. Maybe the next year we have 5. And if you continue this logical, chain long enough, you'll get to a point where basically the central bank is the only funder. They're not the funder. They're not the buyer of bonds of last resort. They're the buyer of bonds of only resort. And when that happens, that means a full-blown, inflationary crisis will emerge in the U.S. And again, the gold bugs I've always been right about this in the long term. But the question is, when does the long term arrive? And it wasn't in the 90s and it wasn't in the 2000s. They were way too early.
So I have a much less intelligent question. Where do you even buy crypto anymore? Because I was on FTX and I got out like hours before it exploded. And so I have all of my crypto sitting on a drive in my safe and have never touched it since then. Obviously I'm a little paranoid, but last time I tried to send some crypto, actually I was paying for the audio you heard at the start of the show. It was quite difficult to do so. So what exchanges are still up? And I realize this is not a very great podcast question. It's a personal question, but nonetheless.
Sure. So you can use, if you want to use KYC, there's, obviously Coinbase and Kraken and others who are, there's also Exodus Wallet, which is another one where you can buy and sell crypto. There are also some non-KYC options, which I can share with you offline. Although those are, like I said, they're more spicy. You're not supposed to be using them, et cetera, et cetera, et cetera. But those are other ways you can get cryptocurrency, decentralized exchanges that are, you're able to dodge government surveillance, and so the government won't know how much you have. But even if you just buy through an exchange, if you use coin joins and other mixers, you can also avoid government tracking of your crypto.
Well, to the federal agent, no doubt listening to this podcast, that was a purely hypothetical question. I don't even know what cryptocurrency is. But if I did, that's something I'd want to know. But anyway, man, it was really great talking to you. If people want to find more of your work, what's a good way for them to do that?
Sure. So they can find me on Twitter at Peruvian Bull, just Peruvian_bull, no caps. And then if you go on YouTube, I'm also at Peruvian Bull, and then Substack is called The Dollar Endgame, where I write about macro, the US, China, Japan, Europe. And I also have a podcast on there that's a paid podcast, but I have really, high level guests on that talk about all kinds of different, really complex macro topics.
Well, sure thing, man. Like I said, I really enjoy your work. Glad to get you on. As far as my stuff, the Jay Burden Show is available on Apple, Spotify, YouTube, anywhere you listen to podcasts. Also, if you're interested in supporting the show, Axios Remote Fitness and Coaching is the best way to do that. JD, the guy who owns it, is a personal friend. And I just hit a PR on bench 2 sessions in a row, thanks in no small part to JD. So highly recommend his services. Again, man, thank you so much for coming on.
Of course. Thanks for having me, dude. I really appreciate it. I'm excited to come on anytime you want me.
And everyone at home, keep your head up. The lie can't last forever. Good night.